What if I told you that a quiet statement from the DWP could delay your retirement by a full year? And most people have absolutely no idea it applies to them. If you were born after a certain year, the rules around your earnings, your pension age, and even how much tax you pay in retirement have all changed. And the government is not sending you a letter about it. So if you want to know exactly where you stand, stay right here. Because what I am about to share could save you thousands of pounds and years of confusion. Welcome to UK State Pension with David. I am your host, David, and this is the channel where we cut through all the government jargon and give you straight, honest, and up-to-date information about your UK state pension. Whether you are already retired, approaching retirement, or still planning ahead, this channel exists to make sure you never get caught off guard by changes that affect your money. Today, we are talking about a significant DWP statement that has come out regarding earnings and the people it affects most, specifically those born after a particular year. This is important, this is current, and this could directly affect your financial future. So let us get straight into it. Let us start with the single most common question that people ask when they are approaching or already receiving their state pension. If I keep working and earning money, will it reduce my state pension? The answer from the DWP is clear: no. Your state pension will not be reduced because of your earnings. Once you reach state pension age and you start claiming, it does not matter whether you are working part-time, doing freelance work, running a small business, or picking up any other form of income on the side. Your weekly state pension payment remains exactly the same. The DWP has confirmed this position, and it is also backed up by guidance from Citizens Advice. So on that specific point, you can breathe easy. But here is where things get more complicated, and this is the part that most people completely miss. Just because your state pension is not reduced does not mean your earnings have no consequences at all. There are two major areas where your extra income can absolutely affect your financial position in retirement. The first is income tax. The second is means-tested benefits like pension credit, housing benefit, and council tax reduction. Let us go through both of these carefully. When it comes to income tax, the personal allowance in the UK is currently frozen at £12,570 per year. This freezes in place until 2028. Now here is the problem. The full new state pension is currently worth around £11,973 per year. That is already very close to the personal allowance limit. So if you add even a small amount of extra income on top of that, whether it is from a part-time job, a private pension, a workplace pension, or any other source, you can very quickly push yourself above the £12,570 threshold. And once you cross that threshold, you start paying income tax. Let me give you a real example so this makes sense. Imagine someone receives the full new state pension of around £11,973 a year. They also receive a small workplace pension of just £1,500 a year. Their total income is now £13,473. That is £903 above the personal allowance. At the basic rate of 20% income tax, they would owe around £180 in tax that year. Now that might not sound like a huge amount, but many people in this situation do not even realize they owe any tax at all, and that can lead to unexpected bills, penalties, and a lot of stress. Experts are warning that over 1.6 million pensioners could find themselves pulled into the income tax net by 2026 because of this frozen threshold combined with the triple lock pension increases. The lesson here is simple. Add up all your income sources, compare that total to the personal allowance. If you're above it, register with HMRC and make sure your tax affairs are in order before it becomes a problem. Now let us talk about the other major impact: means-tested benefits. If you are receiving pension credit, housing benefit, or council tax reduction, any extra earnings you bring in could reduce what you are entitled to or remove your eligibility entirely. These benefits are calculated based on your total income, so every pound you earn on the side is taken into account. This does not mean you should avoid earning extra money, but it does mean you need to report any changes in your income to the DWP and your local council straight away. Failing to do so is not just a financial risk, it can actually lead to overpayment clawbacks and, in serious cases, legal consequences. Now let us move on to the biggest piece of news from the DWP. The the change to state pension age that affects everyone born after April 1960. The state pension age in the UK is currently 66, but that is changing. From the 6th of May 2026, state pension age will start rising gradually, and it will reach 67 by the 6th of March 2028. This is not a rumour or a proposal. This is confirmed government policy, and it means that if you were born after the 6th of April 1960, you will have to wait longer than you may have expected to claim your state pension. Let me break this down clearly so you can work out exactly where you stand. If you were born before the 6th of April 1960, nothing changes for you. Your state pension age remains 66. If you were born between the 6th of April 1960 and the 5th of March 1961, your state pension age will be somewhere between 66 and 67, depending on your exact date of birth. It will increase gradually on a sliding scale. And if you were born on or after the 6th of March 1961, your state pension age will be 67. To give you specific examples, if your birthday is the 31st of July 1960, you will be able to claim your state pension in November 2026 when you are 66 years and 4 months old. If your birthday is the 31st of January 1961, you will claim in November 2027 at 66 years and 10 months. And if you were born after the 5th of March 1961, but before April 1977, you will claim at exactly 67. And looking further ahead, the government has also signalled that state pension age will eventually rise to 68 for those born after April 1977, with that change expected to happen between 2044 and 2046. However, this is subject to review and has not been fully legislated yet. The critical point here is that these changes could mean you need to work longer than planned, or that you need to draw on savings or other pension pots to bridge the gap. If you have not already checked your own personal state pension forecast, I strongly urge you to do that today. You can do it for free on the gov.uk website using the Check Your State Pension tool. It will show you your exact state pension age, how much you are forecast to receive, and how many qualifying national insurance years you currently have on your record. Speaking of national insurance, this is something that many people overlook, and it is costing them money. To receive the full new state pension, you need 35 qualifying years of national insurance contributions. To receive any state pension at all, you need a minimum of 10 qualifying years. If you have gaps in your national insurance record, perhaps because you were unemployed, living abroad, or working part-time without reaching the earnings threshold, you may be receiving less than you are entitled to. The good news is that in many cases you can pay voluntary national insurance contributions to fill those gaps and boost your pension. But there are deadlines and rules around this, so the sooner you check your record and take action, the better. Now let us talk about something positive, the triple lock guarantee, which is still in place and is still working in pensioners' favour. The triple lock means that the state pension increases every April by whichever is the highest of three measures: the rate of inflation, the growth in average earnings, or 2.5%. In April 2025, the state pension rose by 4.1% because average earnings grew by 4.1% in the relevant measurement period. This took the full new state pension from £221.20 per week to £230.25 per week. And for April 2026, the DWP has already confirmed another increase, this time by 4.8%, bringing the full new state pension to approximately £241.68 per week. That is a meaningful increase, and it is something every pensioner should be aware of. However, and this links back to what I said earlier about income tax, these triple lock increases are also pushing more pensioners above the personal allowance threshold. So while your pension is going up, your tax bill may be going up too. It is a situation that needs careful monitoring every single year. One more thing I want to flag before we wrap up: a reminder about state pension payment security and bank verification. The DWP has been rolling out a process to verify bank account details for pensioners receiving payment. If your bank details have changed and you have not updated them, or if DWP is unable to verify your account, your payments could be delayed or temporarily stopped. Make sure your payment details are always current and up to date. If you receive any communication from DWP asking you to confirm your details, do not ignore it. Deal with it promptly through official government channels only, and be cautious of any scam calls or messages pretending to be from DWP, as these are unfortunately very common. So there you have it, everything you need to know about the DWP statement on earnings changes and how it affects those born after 1960. The key things to take away from today are these. Your earnings will not reduce your state pension, but they can affect your tax bill and your benefit entitlements, so always keep track of your total income. If you were born after April 1960, your state pension age is rising, and you need to plan accordingly. The triple lock is delivering another increase in April 2026, and that is good news, but it comes with a tax warning. And finally, check your state pension forecast on gov.uk today. Do not leave it to chance. If you found this video helpful, please give it a like and share it with anyone you know who is approaching retirement or already receiving their state pension in the UK. Every share helps us reach more people who genuinely need this information. And if you have not already subscribed to UK State Pension with David, please do that now so you never miss an important update. I am David, thank you so much for watching, and I will see you in the next one. Take care.